Welcome to The Explainer. Today, we're digging into a super frustrating but common experience for traders. Why does the market so often seem to know exactly where your stop is? We're going to pull back the curtain on the hidden game played by the big institutional players and show you how to start thinking like they do.
So let's kick things off with a feeling that I'm sure is way too familiar. You've done all your homework, you found the perfect setup, you placed your trade, and then the market moves, all right, but just enough to nick your stop loss. And then, boom, it rockets straight to your original target without you. We're going to lean on the insights of pro trader Abhay Patel to figure out exactly why this happens and, more importantly, how you can avoid it.
So here's our game plan for today. First, we'll break down the common trap that catches about 90% of retail traders. Then, we'll get into the mind of the market makers. And finally, we'll give you two powerful strategies to flip the script, the red box and the black box.
All right, let's dive right into the heart of the problem. Why is it that all the conventional wisdom, all the stuff you learned in trading books and courses, seems to fall apart in a live market?
This quote from Abhay Patel just nails it, doesn't it? It's the core dilemma. You've put in the hours, you've memorized all the chart patterns, support and resistance, double tops, breakouts, you name it. And yet, it feels like the market has a personal vendetta against you, knowing exactly where you entered and where your stop is.
I mean, look at this. This is trading 101, right? You see a clear support level, you wait for it to break, you jump in on a sell, and you tuck your stop loss just above it. It's perfectly logical. It's what every book tells you to do. But here's the kicker. Its predictability is exactly what makes it so vulnerable.
So, what's really going on behind the scenes here? Well, it's not just about pretty patterns on a chart. It's about a fundamental force that moves the entire market, and that force is liquidity.
Okay, so here's the key thing to understand. If a huge institution wants to sell, say, $1 billion worth of stock, they can't just hit the sell button. The price would absolutely crash. They need $1 billion worth of buy orders on the other side to absorb their sale. They have to go hunting for that liquidity. And where's the biggest pool of orders? You guessed it. It's right where everyone places their stops.
And this slide right here perfectly illustrates the conflict. It's two completely different mindsets looking at the exact same chart. The retail trader sees that support level break and thinks, okay, time to go short. The market maker sees that exact same move and thinks, fantastic, a whole bunch of sellers are jumping in and all the buyers' stop losses are about to get hit. That's the pool of orders I need to fill my own huge buy order. See the difference? One is trading the pattern. The other is trading the reaction to the pattern.
So this brings us to our first real strategy for fighting back. It's called the red box. And it's all about learning how to profit from those fake breakouts that are designed to track everybody else. You're basically anticipating the liquidity hunt. Here's how the red box setup works. It's a four-step dance. First, you have the bait, a really obvious support or resistance level that everyone on the planet can see. Then comes the trap. The price smashes through that level, triggering all the stops and sucking in all the emotional breakout traders. But you wait. You're looking for the signal, a fast, strong reversal right back across that broken level. That is your entry point, trading against the very crowd that just got trapped. At this point, it's pretty much game over for the trap traders. The institutional players got what they wanted. They filled their massive orders at a great price by absorbing everyone else's sell orders. Now, with their huge volume, they can easily push the price back up, leaving all those who sold the breakdown in the dust. Okay, but what if the market is in a really strong trend? Trying to trade a reversal can feel like standing in front of a freight train, and that's where our second strategy comes in, the black box. This one is all about trading with the trend, but only after the market has shaken out all the impatient traders first.
You know, the logic here is really all about patience. So in a strong uptrend, you see a breakout. That's your alert, but you don't jump in with the FOMO crowd. No, you wait. You actually anticipate that the market's going to pull back to trap those very buyers. And when it does, it stops them out. When you see the price find its footing and start to move back up in the direction of the main trend, that's your entry. You're basically buying the dip that was created by the stop hunt.
This quote really gets to the core of the black box idea. The reason the market so often hits your stop and then goes your way is that typical entry points, like an immediate breakout, are actually the most vulnerable places in the market structure. The black box teaches you to wait for that structure to break for everyone else, and then you get in when the coast is clear. So, now you've got two pretty powerful tools in your arsenal, the red box for reversals and the black box for trends. But which one do you use? Well, the answer really lies in learning to adapt to whatever the market is giving you on any given day. This is such a perfect analogy. Markets are not static things. They have personalities. Sometimes they're volatile and choppy, just bouncing around sideways. Other times they're in a clear, strong trend. Your strategy has to match the environment. If you just stick to one approach no matter what, well, that's a recipe for disaster.
And your own personal trading style has to play into this too. A choppy, range-bound market is perfect for scalping quick little red box reversals, but that means you're glued to your screen. On the other hand, in a strong, clear trend, a black box entry on a higher time frame might be a much better fit for a swing trade that you don't have to babysit. The goal is to find a style that fits both the market's personality and your own lifestyle.
And this brings us to what might be the single most important takeaway. Market makers know that retail traders love to place their stops just a few ticks below a key level, like say at $100. So they aren't going to push the price to $99.99. They're going to push it to $99.50 just to be sure they sweep up all those orders. That's why you have to stop drawing these perfect thin lines on your charts and start thinking in wider zones to account for this kind of manufactured volatility.
So, I'll leave you with this one question to ask yourself before every single trade you take from now on. Don't just ask, what pattern is this? Instead, ask, what is this pattern designed to make the crowd do, and how can I trade the reaction? Making that one little shift in your perspective can honestly make all the difference in the world. Thanks for tuning in.